In this video, traders, we're going to look at 10 risk myths. Stay tuned. Hey traders, a very warm welcome to you. So 10 risk myths, 10 things that you often hear about trading surrounding risk that are most likely not true. Number one, let's get going. Stops will protect you. They will under certain circumstances, right? The majority of the time they're going to. If you're trading Euro US dollar during normal market hours, not holding over the weekend, small size, 999 times out of 1,000, they're going to protect you absolutely fine. But they don't always protect you against big gaps overnight. If you're trading stocks, if you're trading something that's closed, they don't protect you as well for things like extreme moves, because a stop is basically triggered when that price is traded. If something really drastic happens during the trading day or during the trading evening, it just goes from one price to another. There's a liquidity problem or whatever it may be. Someone just smashes a market order in. It's a fat finger. Your stop won't execute at the price that you want it to. It will be triggered, but the price you get filled at will be much, much lower or higher if it's a buy stop. So whilst it will protect you the majority of the time, a lot of the time it won't. So you've got to be mindful of that. You've got to have other risk management tools in place. Number two, pair trades are not risky. Pair trade being buying one asset, selling the other, correlated assets. So for example, we could be buying two stocks like Pepsi, Coke, or UPS, FedEx, or any of the other kind of things like Sainsbury's, Tesco's was the one that comes to mind, the UK shares. Anything like that where you have an asset that's very similar and you're basically trading the difference between the two. So you're somewhat protected from the market moves, but predicting or trading on the differential between two is no difference really to trading direction. It's a strategy in itself. Is it less risky? No, it's insulated a little bit from sector and market moves, because if the market suddenly goes up, those two stocks go up, your short loses money, your long makes money, yes, but you're still trying to make money for something. So making money on direction is then replaced with making money on the ratio. So is it less risky? No, it's not, because you've still got risk on the table, and most of the time people are trading in bigger size because they're looking for a much bigger move ultimately, although the moves are less, but they need a kind of larger gain on the small move to make it worth their while. Number three, tight stops equals less risk. This is one I hear quite a lot. Well, if I've got a tight stop, it's fine. Now, yes, in that trade, but you have the death by 1,000 cuts syndrome. In other words, if you have a tight stop and it's too tight, you're going to get pinged and pinged and pinged and pinged and pinged, and getting pinged 10 times on 10 pips is the same as getting stopped out once on 100 pips. In reality, just trading one trade with a 100 pip stop may well be way less risky than trading 10 times 10 pips. So think about that in terms of the frequency. Yes, it may be on a trade basis, but you'll probably be trading more, so the total risk becomes the same, if not more. Okay, quiet markets are less risky. Now, from a perspective that, okay, volatility can be risky if you're trading size, but you can you can dampen down the risk of volatility with reducing your position size. I think quiet markets are potentially more risky because you tend to want to trade more, you tend to try and force stuff, there's not as many frequent setups, and they also lull you into a false sense of security that a big spike could come from somewhere and kind of catch you off guard, and you might be in bigger size because you're trading bigger size because of the quiet volatility. Number five, you won't blow up if you know what you're doing. Big myth this, and there's a little bit of jest in this one because we've seen kind of hedge funds blowing up and they're supposedly professionals. Risk comes from places that we don't really see. This is why crises happen. We see new things happening all the time. Liquidity sucking out of something. We didn't see it coming, or we allegedly didn't see it coming, and we're so blinkered. So just because we know what we're doing doesn't mean that we're completely infallible to risk and to tail risk as well. So just being aware, always keeping a step back and saying, where's the risk in this portfolio I've got? Where's the risk in this trade? What could happen? Is that likely? Am I accepting the risk? And kind of going into it with your eyes wide open. Number six, FX is less risky than stocks. From a certain perspective, I see why people are saying this, because stocks can move really dramatically based on Newsflow. And Newsflow does move currency pairs, but it's a little bit less, right? But in the day, guys, it's still an instrument that is moving aggressively. And don't forget, we've got some minor pairs and some exotics which move like tech stocks sometimes, you know, have something coming out and the liquidity is not there to soak up that two-way flow, and the flow is more like one way, and we get those extreme moves. So, you know, that's a bit of a myth. I think that it needs just as much respect. FX needs just as much respect as stocks do. And, you know, let's be honest, we know people who have blown up trading currencies, and we know people who have blown up trading stocks. All right, number 7, guys, gaps are dangerous. Now, from a perspective of if you're not allowing for the gaps, yes, they are, because you're going in with your eyes shut, your head in the sand, and all of a sudden something gaps 20% overnight. If it's a stock, or it gaps on Sunday night, if you're trading currencies based on some sort of news flow over the weekend, then yes, they're dangerous because you're not prepared for them. Now, gaps can present opportunities as well. We've talked on this channel about gap trading strategies, and I specifically like trading gap strategies as well when we're trading equities. So yes, they can be. So maybe this is like a half myth, but if you're managing for them and you're expecting them, and you're trading expecting some kind of gap, then the risk can be managed. So don't shy away from it, is what I'm trying to say. Number 8, less time to trade equals less risk. In theory, that makes sense, because the less time you're exposed to the market, you've got open position, the less vulnerable you are. However, it's not really the case, because that encourages you to cut your trade short. And what happens is, you say, well, I don't want to be in this trade long, I don't want to be exposed, you cut it short. But then you go into a new trade, and a new trade, and a new trade. So your total exposure time is still about the same as if you had one trade and you were holding it for a longer period of time. Now, if you're in a trade and you hold it for a longer period of time, the risk kind of reduces. Now, this is a bit of a controversial one, because as you getting profit, yes, you can still lose that profit that is still effectively yours, but is that risk the same as risking money that you didn't have and it's a loss scenario? Maybe it's not. So the concept of less time to trade equals less risk is really a fallacy. It is if you can go in and out and that's it, you're done for the month, whatever it may be, but it's very rarely the case. The best trades come from when you're extracting the most profit. You're in the right trade, you're in the right direction, and it's going. You're pressing it, and you're making it pay you for taking that risk. Because the most risky part of a trade, from my perspective anyway, is when you take it. Initially take it, you've got your stop in. That's the most risky part. As it starts to go in your direction, you can adjust, you can adapt your stops, you can move your stops. You're in the cruise. The trade becomes less risky in terms of damaging you. Yes, you're giving back some profit, but less risky in terms of reducing your capital. Or number 9, unexpected moves cause the most risk. In reality, that's not the case, guys. Most people don't get wiped out by an unexpected move. Most people get wiped out by a normal move that they just have not accounted for. They're trading too much size for, or something's not quite right in it. So, you know, whilst we should be, wherever it was, looking out for, you know, across the whole bigger picture and saying, where's the unexpected move going to come from? Where's the hidden risk in this deal? The actual expected moves, when it's stopping us out, when it's doing this, doing that, are the things that cause the most risk, because they cause damage after damage after damage. And before you know it, you know, 10 of those normal stop outs can equal one dramatic move. So it's the risk that right in front of us that we need to pay attention to. And the final one, which is the most important one, is the biggest risk comes from the market. And you're saying, what are you talking about? The biggest risk comes from the market. How is that a myth? The biggest risk comes from ourselves. The market will move, and that's where the opportunity presents itself. We can't get opportunity and make money if we don't take risk. So we have to get involved in the market to do that. The biggest risk comes from us. If you look at all these things, it's how we perceive it and how we manage and how we adjust and how we present our trades. You know, if we're trading and we're worried about tail risk and we're not managing for it, then we're going to get caught out. If we're not worried about normal day-to-day risk, we can get stopped and stopped and stopped. If we're trading too tight stops, we're going to get stopped frequently and have the death by 1,000 cuts thing. The biggest risk comes from us not managing risk effectively. It comes from us trading on tilt, trading with emotion, not trading with discipline. That's the biggest danger to our account, is us. It's not the market, it's how we position for the market, how we trade for the market. The market is what it is. We know what it is, we know what it can do, we know how it can move, we know all the things, but how we actually manage our trades and how we react to certain things is the biggest risk to us. So if we can get a grip on ourselves, grip on our trading emotions, grip on our discipline, a grip on our firm grip on our risk management, then we can trade almost anything. Because if we have that, we have it under control, we've got the risk by the reins, we know where the real dangers can come from, and we can trade and navigate the markets with less risk. We're never going to eliminate it, but we can reduce it. All right, guys, 10 risk myths. If you've got any comments in the comment section below, see you next one. Take care. Bye-bye.